What if the next recession hits in 6 months? Would your portfolio survive or would it collapse?
Oof. Yeah. That's a heavy question, but a really important one right now.
It really is. And that's kicking off our deep dive today. We're looking at this idea that what you do before things potentially turn down is, well, absolutely key.
Right. It's not just about bracing for
Yeah.
impact. The source we're looking at talks about building what they call a millionaire portfolio, specifically designed to actually grow before any storm hits.
Interesting. So proactive growth, not just defense.
Exactly. And they acknowledge where we are, The S&P 500, maybe 22 times forward earnings.
Yeah.
Pretty high.
Yeah. Priced for perfection, I think is the phrase often used.
AI stocks are flying. But beneath that shiny surface, the source points out these persistent risks still lurking.
Such as.
Well, you still got inflation concerns, global stuff, geopolitical risks, and maybe some potential pressure on company profits later on.
Okay, so it's not all smooth sailing ahead, potentially.
That seems to be the view.
So the strategy they're suggesting isn't about chasing, say, the next hot AI stock.
No, quite the opposite, actually. It's about shifting focus more towards building a solid foundation.
Right, okay. And they have principles for this.
Yeah, 3 core ideas for picking stocks for this kind of portfolio. First,
Huh.
defensive stability. Basically, protecting your money if the market does take a hit.
Makes sense. Principle number 1, protect capital.
Second, cash flow quality. You want things that are actually, earning money while you wait. Reliable income.
Got it. Earn while you wait. And the third?
Asymmetric upside. This is the interesting one. Looking for stocks that have the potential for, exponential growth when the market eventually turns back up. Much more upside potential than downside risk.
Okay, stability, cash flow, and then that big growth potential. So our mission here is to unpack the 5 specific stocks they think fit this bill.
Exactly. These are their high conviction picks for this foundation.
All right, let's dive in. Who's first?
Leading off is Costco, ticker COSTI. They see this as a top-tier cash flow generator, even calling it a recession compounder.
A compounder during a recession. How so?
Well, think about their business model. That membership fee, it provides this incredibly predictable revenue stream. Customers are super loyal.
Okay, yeah. Their renewal rates are famously high, right?
Over 92% in North America, the source highlights. That sticky revenue, plus their sheer size, helps them pull in over $6 billion a year in free cash flow.
And free cash flow is basically the real cash the business generates after all its spending shows real strength.
Precisely. And they point out Costco actually did well, relatively speaking, in the '08 and 2020 downturns, the forecast mentioned. Potential for 35–50% upside. Targets like $1,100, $1,300.
So it ticks the box for protecting capital and growing wealth over time. Okay, interesting. Who's next?
Moving from compounding to more foundational defense, Walmart. WMT, positioned as the defensive anchor.
Walmart makes sense for defense. People need groceries, essentials, recession or not. They often trade down to Walmart.
Exactly. And the source emphasizes its growing digital side, too. It's becoming like a quiet rival to Amazon in some ways.
Right. Their online sales have been growing strongly. I saw U.S. online up 22% recently.
And they're working on profit margins, too.
Hmm.
So it's that predictable durability, but also with this sort of underappreciated tech angle. The forecast cited is pretty steady, maybe 5–8% annual earnings growth, stability.
Okay, anchor established. What about income and preservation?
For that, they pick Exelon, EXC, a large regulated power utility.
Ah, utilities. Often seen as safer income-generating plays. What Exelon specifically?
Well, regulated earnings mean stability. People need electricity regardless of, interest rates or how consumers are feeling. It's less sensitive.
Right, less volatile than many other sectors.
And the numbers look reasonable, according to the source. Forecasts around 5–7% yearly earnings growth, a decent dividend, maybe 3.5% yield, and the valuation around 16 times earnings seems attractive for that kind of stability. Protects principal, throws off cash.
Okay, so we have the anchor, the compounder, the stabilizer. What about that growth piece, the asymmetric upside?
That's where advanced micro devices comes in, AMD. This is the potential growth catalyst, tapping into the future, especially AI.
AMD. Okay, so they're betting on their role in AI infrastructure.
Yeah, big time. The source highlights their revenue growth up 36% Q1 '25, data center revenue soaring 57%, driven by new AI chips.
Like the MI300 series, getting traction with big clients.
Microsoft, Meta, OpenAI. they're winning deals.
Hmm.
Now, there are challenges. Sure, regulations, NVIDIA's tough competition, but the potential upside in AI, edge computing.
The bull case is strong, basically.
The source suggests potentially 50% plus upside by 2026 in their optimistic view. It's that calculated bet for a much bigger future reward.
Makes sense. You need some growth engine.
All right, number 5.
The final piece is McKesson, MCK. They call this one the hidden compounder, or the recession-proof healthcare backbone.
McKesson, less of a household name than the others. What's the angle? It's kind of the secret weapon, maybe. Their core business is drug distribution, logistics for the whole U.S. pharma supply chain.
Ah, so they're like the plumbing,
That's
essential but maybe not glamorous.
Exactly. They avoid some direct healthcare risks like fighting over drug prices or insurance issues. They just distribute the medicines. It's stable, essential.
And presumably consistently profitable.
The source says it basically prints money because it's indispensable. Analysts cited see significant upside, maybe over $600 a share in the next 12-18 months. Consistent cash flow, reliable.
Okay, so putting it all together, this isn't just a random list.
Not at all. The source presents them as a structure. Walmart's the anchor.
Costco, the defender and compounder.
Exelon, the stabilizer for income.
AMD, the potential growth exploder.
And McKesson, that hidden compounder for steady cash flow. They work together.
So the big takeaway here, connecting back to the start, building real wealth before a potential recession involves thinking strategically about these kinds of foundational holdings.
That's the core idea from this source, yeah. They suggest, track these names, really understand their businesses, maybe consider dollar cost averaging to build positions.
Right. The point is, don't wait until the storm hits to prepare your ship, so to speak.
Get ready beforehand.
Which leaves us and you listening with that final thought. Based on this kind of thinking, what stock do you believe belongs in a millionaire building portfolio right now?